Hello and welcome to part 2 of the lecture for Chapter 8. So I want to start with the discussion of different classes of stock. So up until now we've just talked about shares of stock in general. So those shares of stock can fall into two categories. Most companies just have common stock. So if they don't specify, then by default it's all common stock, meaning every share is equal to a different share. Okay. Some companies choose to have something called preferred stock, which is a different class of stock that has different rights associated with it. Preferred stock, as its name implies, gives preference to those stockholders in terms of dividends and potentially assets upon liquidation. They're in this cheesy little graphic there from a textbook I've used in the past, just shows that they're basically first in line to get dividends. So if the company has preferred shareholders, the dividends that are associated with those shares would be expressed either as a dollar amount in the description of the share, like this share pays $1 a year in dividends, or a percentage of its par value. So maybe the par value is $10 and it's at 10%, so that would pay $1. Could be expressed either way. And it could be cumulative or non-cumulative. So what cumulative means is if the company, say they have 10,000 shares of preferred stock and it pays $1 per share in dividends. So what that means is when the company at the end of the year says we've had a good year, we have enough retained earnings, we have enough cash on hand, we want to pay a dividend out to our owners to reward them for their ownership, the first $10,000 is going to go to preferred shareholders, and then anything remaining will go to common stock. So if you're purchasing preferred stock and you want consistent dividends, then buying cumulative shares would be better. And what that means is if there's a year where they don't have cash and the next year then they go to pay dividends, they have to first pay the amount that was due the first year and then pay the second year. So they have to make up any gap that they've had. Non-cumulative means if we have a year that wasn't good and we don't pay a dividend, well, that's too bad, so sad. You're not going to get the money. So that's the distinction between the two. So generally, preferred stock is going to have a potentially less upside, but less downside as well. So kind of a steadier type of investment. Quite often, preferred stock doesn't have voting rights associated with it either. So when a company issues stock, so that's an initial public offering if it's a public company, or it's just issuing shares to new owners. So I would distinguish that from the transactions that happen with those shares afterwards, which is, say I invest money in a corporation and they issue me stock, and then I chose to sell that to another individual. That second transaction doesn't pertain to the company at all. So when stock is initially issued, it needs to be for an amount above its par value. So when that takes place, cash or some other asset that they've contributed in return for shares of ownership, it could be land or a building or a machine or a patent or something, that's going to increase. And then common stock is going to go up, and a new category we haven't talked about yet, paid in capital in excess of par, will also go up. So common stock, that category will go up by the number of shares times the par value per share. Any extra amount will be under paid in capital in excess of par. So here we have an example where we issue 10,000 shares of $1 par common stock. We issue them for $10 per share. So the market value is $10 per share. That's what people are willing to pay for a share of this company. But the par is usually a much lower figure, which in this case is $1. So in transaction one, cash goes up by $100,000, common stock goes up by 10,000 times $1 or 10,000, and the remainder goes to paid in capital in excess. The second transaction there is a non-cash transaction, so somebody contributes a building that has a market value of $50,000, so it's been appraised at $50,000, and they issue it in return for 5,000 shares of $1 par common stock. In that case, building goes up because the corporation now owns that building, its assets have increased, it's going to come on the company's records at fair market value, $50,000. Common stock will go up by the 5,000 shares times $1, and the difference will go to paid in capital in excess. So I mentioned earlier about treasury stock being the difference between the shares that have been issued and the shares that are outstanding. So treasury stock is when a company has issued shares and then they decide to reacquire them, to buy them back. It's a contra account, meaning it's going to have the opposite balance of its neighbors. So in the equity section on the balance sheet, common stock, preferred stock, paid in capital and excess are all going to be positive numbers. Treasury stock will be a negative number. Companies will buy back shares for a couple of different reasons. One would be to potentially provide shares to employees for bonuses, but more likely than not, it's to raise the market price of the stock. So when you read about this in the paper, I read recently where Intel spent tens of billions of dollars buying stock back, and now they don't have that cash to build more factories. So the reason companies will do that is it's a way to boost their stock price. And many times management is provided with incentives or bonuses if their market price of the share goes up. The reason for that is the value of a company that's reflected in their share price is based on an expectation of future profits. So it's based on an expectation that the company is going to grow and continue to be profitable and maybe even increase that profitability. I mean, if you bought a share of Tesla right now, it's because you expect positive things in the future from that company. So it's not based on how much cash they have in the bank. So if the market value per share is the market value of the company, so that expectation of future profits divided by the number of shares, that'll give you the market value per share or the price per share. Well, if you reduce the denominator, if I had 100 million shares and I reduce that to 80 million, but the value of the company didn't change, that's going to give me a higher market value per share. So that's why companies engage in that behavior. And it's somewhat controversial because money spent in that way doesn't necessarily make the company a better company, make them more competitive or more resilient or anything like that. So it's a bit of a manipulation, really. So the cost method is what's used in accounting for treasury stock. So basically we can ignore par and just say, what did we pay for the treasury stock? And if we reissue it later, what did we reissue it at? And is that result in a gain or a loss? So we don't want corporations to manipulate their bottom line. So we don't funnel that gain or loss through the income statement. We don't want companies engaged in buying and selling treasury stock as a way to boost profit. So we handle that through the equity section. So the way that looks is in this first transaction, we buy 2,000 shares of our own stock at $20 per share. So cash goes down by $40,000. We're writing checks to existing shareholders for a total of $40,000, and they're sending us their shares back. So cash goes down by $40,000, and that contra account within the equity section, treasury stock, goes down by $40,000. It increases by $40,000, but that's a negative balance. So then 1,000 of the shares are sold later for $25 per share. So we'll receive $25,000 in cash, and we want to make sure that we reduce that treasury stock number based on the $20 per share cost of those shares. If money goes into treasury stock at $20 per share, we want to make sure it comes out at $20 per share, or we'll end up with a weird residual once we've sold all the treasury stock, and that wouldn't make sense. So we're going to reduce that treasury stock figure by $20 per share cost times 1,000 shares. That's the positive $20,000 figure there. And the addition and any extra, which in this case is a gain, increases our paid in capital in excess account. So that gain again won't be on the income statement, it'll be on the equity section of the balance sheet. Now companies pay dividends, and you might ask, why would a company pay money out like that? Well, remember in that diagram I showed you in the last lecture where the management of the company, the top management of the company, reports to the board of directors, and the board of directors is chosen from the shareholders, the stockholders of the company. So who is it that wants dividends? The stockholders. They elect the board of directors, so the board of directors is going to put pressure on management to pay dividends. Okay, so that's why dividends get paid. So the board of directors, management will come to the board of directors and say, oh, we've had a good year, we have sufficient retained earnings, we have sufficient cash, we would propose sending out a dividend of X, whatever that might be. If the board of directors agrees with that, they'll declare a dividend. That dividend could take the form of either cash, so sending checks out to shareholders, which is most common, or shares, new shares of stock. So again, we must have available retained earnings and available cash to allow for it. And there's 3 dates that are relevant. There's the date of the declaration. It's a legal thing. It creates a liability. There's the date of record, so it's saying all shareholders as of a particular date will receive this dividend, because remember, people are buying and selling shares back and forth, so they have to say as of a particular date, we'll take a snapshot, that's who gets the dividend, and then the date that it's actually paid out. So for a cash dividend here, we have an example where they declare the dividend on October 1st. The date of record is November 1. The payment is December 2nd. In this case, they have a $2.50 dividend per share for preferred stock. That amounts to $12,500. And then a 30-cent dividend per share on common stock, which amounts to $30,000. So they have, the board of directors has approved or declared a dividend of $42,500. So on October 1st, the company would create a liability, which would be a current liability of $42,500, and they would reduce retained earnings like that. Remember, retained earnings are the earnings or profits of the company since its inception that have been retained within the company. So paying a dividend out is going to reduce that amount because we're no longer retaining that earning within the company. We're paying it out. So then on November 1st, there's no transaction to record. We're just merely capturing the names and addresses of the owners at that point and how many shares and which type of share they own. And then on December 2nd, we're writing the checks. We're paying the dividend out, actually. So we reduce cash by $42,500 and eliminate that dividend payable of $42,500. So once that's paid, that goes to zero. Now, some companies that don't have sufficient cash, and I'm thinking of like tech startups and things like that, still want to reward their shareholders, but they don't have the cash to do it. So they might choose to issue some new shares of stock and send those out on a prorated basis to all existing shareholders. So everybody's ownership interest changes or doesn't change because all of them go up by a proportional amount. So if you own 25% of the company, after the stock dividend, you own more shares, but it's still 25% of the total. So that transaction is just transferring money from retained earnings into paid-in capital. So common stock would go up and paid-in capital in excess would go up based on the market value of the shares that we're distributing to the shareholders. A stock split is used when a company's share price gets high enough where they feel that it represents an obstacle for everyday investors to invest in their shares. So as an example, Tesla, last year, I think actually late 2019, their share price was around $600 or $700, and they had a 5-for-1 stock split. So they said, give us your 1 share, we'll give you 5 in return. So they increased the number of shares dramatically in an exchange, which reduced the share price to about $100 per share. So they did that to make the stock more affordable for investors. So no money changed hands. Nobody became richer as a result of that. It was just a way of lowering the share price. So there's no transaction to record for a stock split. It's just an informational thing. So that's about stock splits. And then lastly, I wanted to show you about what it might look like on a relatively complicated balance sheet. So here's really just focusing on the stockholders' equity section. So you can see they've got preferred stock, and it'll state on the financial statement what the stated or par value is. The 7% there shows that it's a 7% dividend is going to be paid based on a $10 stated value. So each share will get, I think, 70 cents or something like that. And then it is cumulative. So if they miss one, they'll pay it later. and it says how many shares of preferred stock have been authorized and how many are issued and outstanding. So the board of directors has said you can issue up to 300 of these shares without coming back for permission, but only 100 have been issued. The next one, there are 2 different classes of common stock, or actually 3 different classes of common stock. Now, sometimes they can do that if they want to have different voting rights associated with different shares. Some companies are selling or issuing shares of common stock that don't have voting rights associated with them. And that there's arguments both ways for that, but you can see the information for each class. We're saying what the stated or par value is. We're stating how many shares have been authorized, how many are issued, and how many are outstanding. Again, in that first one there, common stock $10 par value, 100 shares issued, 80 outstanding. That tells me that at least 20 shares were bought back as treasury stock. If you look down to the bottom, you can see that there. So that totals all that, and then they show the paid-in capital for each of those different categories separately. Then they have retained earnings, and retained earnings can be appropriated or unappropriated. So appropriated means that there is some legal agreement that apportions part of the retained earnings to not be paid out as dividends. So as an example, if somebody, if this company borrowed a large amount of money from a bank, that bank might want to have some protection that all of the company's cash isn't going to be paid out, or all of their retained earnings won't be paid out as dividends, that some of that will be retained in the company so that it can be used to pay off that debt. So that kind of a legal agreement for debt is usually what results in part of the retained earnings being appropriated, which just means it's roped off and not available for dividends. And then you can see that we subtract the treasury stock at the end based on the cost. So that would be a negative number. So that's the end of the lecture for Chapter 8. I look forward to talking to you when I lecture on Chapter 9. Thank you.